All right, we have Aaron Gibbs back with us, Dan Geltrude, Rebecca Walser on this money, because how it is spent, if it's spent at all, is going to be very important, I guess, for the economy. Aaron, if people just save it, of course, they can do whatever they want with it. It's their money. But the argument is always that if they do that, it won't have much bang for the buck. Do you agree with that? And what do you see happening?
Right. So if we looked at the last stimulus check and the hurdles to get the checks were even lower, you could make more money. About 1/3 went to spending immediately, 1/3 went to savings, and 1/3 went to paying down your debt. Now, we know with higher gas prices, higher interest rates, we might see a little more going to spending and paying down your debt, especially if your credit card interest rates are going higher, and a little less on savings. And so I think that would be expected given where we are this year versus last time, and that we're going to see a much lower savings rate.
You know, we've seen savings go kind of through the roof, right, Dan? And then a lot of people have really shored up their finances and their balance sheets here. I'm just wondering, given this added cash, and we forget about things like the child tax credit and all that could raise this, depending on the number of kids, by thousands of dollars more. What do you think happens here?
Well, I think a lot of people, if they can, are going to continue to save the money, Neil. And when you look at it, based upon what Aaron just said, if 1/3 of the people who are getting stimulus checks are simply saving that or putting it in the bank, it means that this program is not targeted enough, because this money is not supposed to just go into a savings account. It's supposed to be used for the necessities, food, utilities, rent, those types of things. So I think what that information tells us is that it is not focused in enough on the people that really need it. So I believe if we were going to help people out, we probably should have given more, but have it more targeted as to who gets it.
You know, just looking at the markets, Rebecca, it's clear that whatever the cost of stimulus and whether it drives us deeper into debt, the financial community doesn't really seem to care, just that it's going to be more stimulus and that, all that's good. Will this be a boom year as a result? And this is just helping it along.
Well, that remains to be seen, Neil, and it really does depend on what our reopening looks like second half of the year, like we've been saying all along today. We did see, to Aaron's point, we did see a 2.4% increase in January in personal spending when we got that $600 stimulus. So about 38% did go, to Dan's point, to what we need: rent, food, utilities. So we do see some personal spending. This is almost a check that's almost 3 times the size of the $600 in January, and more people are getting it because you can have dependent adults getting it for the first time. So it is more money. I agree with Dan. It's very untargeted. If people are saving this money, then those are the people that, somehow magically, finagled their way through the recession, shutdown without having to, was still saving money, which is incredible. And so it remains to be seen. We have to get back out and get back to normal.
You know, the next part of this, Aaron, is when people get back to the office. Now, the American Express CEO said he doesn't expect all employees to return to the office right away. But Goldman Sachs is making it clear if he had his druthers, I'd like to see them all back in the offices by summer. Most seem to be looking at late summer. I'm talking businesses in general, early fall. How much of an impact will this have on the oomph we see in the economy as people, sort of get out of this pandemic funk?
Certainly. Commuting, obviously spending on gas, buying a lunch in the afternoon rather than making it at home. All these things are going to contribute to getting the economy back to normal. I don't see remote working going away completely, but I think it's really going to be more about more of your leisure, recreational, those types of things that are really going to get the economy going.
Dan, by almost any measure, we're going to see an improvement not only in the quarter we're in, but the year as a whole, albeit coming off very, very low levels. So it will be eye-popping regardless. Any indication that you have or you fear that it might not be as eye-popping?
I think, Neil, that it is going to be eye-popping. I think once this economy can get back to normal, we're going to see really an explosion in the economy. And I think the markets are going to do very well. And I'm just going to put an asterisk on that unless we go into a hyperinflationary period. And if we do, that means interest rates are going to rise. And I think that's going to have an impact on what happens on Wall Street.
Rebecca, Wall Street is, even in the face of the higher rates, and we were discussing it in the prior hour, of the higher gas prices, all these higher prices for lumber and everything that goes into a house that have been rocketing. But it's taken it all in relative stride. What has not, though, by and large, is the NASDAQ, which did, recover from the lows earlier in the week. I'm wondering why that is, why the technology stocks in particular are so sensitive to this backup that's been going on in rates. It's not been an alarming backup, to your earlier point, but it does seem to have a disproportionate impact on technology. Is that because they've run up so far so fast and the first to sort of feel this, or what?
I think it's twofold, Neil. I think you hit the nail on the head. Last year, we really banked on technology stocks to keep us going. We leveraged them. They actually were perfectly positioned to actually grow in a closed society because that's what connects us virtually. So obviously 2020 was the year of big tech and tech stocks in general, a bunch of breakouts we know. But the other thing that's happening is as yields are going up, we have 1.625 on the 10-year now. What people are saying is maybe I can take some gains, take some profits, and go into a little bit of safety. So as they see any kind of opportunity to say maybe I shouldn't have, large cap growth, tech, everything that I'm counting on because the economy's going to go back up. We're going to get some more breadth between sectors. And so that's what's happening with tech is that people are saying it's not going to all be tech this year. It's going to be other sectors too, and maybe even some safety with some treasury positions. So that's what's happening, Neil.
Yeah, I am wondering, too, and as things get more volatile, that gap, we were showing it before with a chart, and I always like to bore people if I can. I've built a career on it. So I look at two very different rates that are now crossing each other. That is the yield on the 10-year note and the yield on the S&P 500. And it used to be a chasm between the two, essentially meaning that it was foolish of you to think of investing in fixed income because you got almost nothing for it. And stocks were the only place to go. Now there's some competition, at least if you want an alternative. Is it, and if this remains the case, should stock investors be worried? And should new investors prone to look at stocks be rethinking that?
So we're still a ways away. We quite haven't hit that tipping point, but it is something that you should be monitoring because once you hit that risk-reward ratio where bonds suddenly look a lot more attractive, you will see and the institutional money managers moving cash from equities into bonds. And that can have a big impact on overall in equities. But I think the bigger impact here is that we're really looking at a cyclical economy. This is all about economic growth that's therefore driving the market. And we're seeing new types of sectors being leadership, like financials, energy, materials. So I think with all this stimulus, we're still pretty safe for now that the stock market is going to do well in, let's say, the next 12 months. Inflation is something that's a little farther out there that you should be worried about, but not just yet.
All right, because I could regale you with a story when my wife and I got our first place, and it was 13.5% interest rate. Oh, I've told that story 100 times. Okay, fine. Guys, I want to thank you all very, very much. Perspective is everything, right? Perspective is everything. By the way, just some perspective on what